Good afternoon. I welcome all of us to our lecture today. And today we want to consider principle of taxations. Under this, we shall consider what tax is. We shall look at number 2, the characteristics or attributes of tax. Number 3, we look at the principle of a good tax system. Number 4, we look at the reasons why governments impose taxes or impose tax and levy. And then number 5, we look at the economic effects of taxations. Economic effects of taxation. And then we look at the classifications of tax. Classification of tax. Then we look at the advantage and disadvantage of taxes. I think we equally would like to look at the concepts of taxes. If time will permit us, we'll look at tax avoidance and tax evasion. And finally, we shall consider the computations of personal income tax. Personal income tax. Let's look at number 1. We're looking at tax, and we have been hearing about tax or levy. But we must understand before we come to the definition that tax is one of the major sources of revenue the governments of the country. It is major for the facilities, for securities, and so forth, that government derive their resources from taxes. Then what is tax? Tax can be defined as a compulsory payment that all citizens or non-citizens earning income in a particular country must pay as at when due. Look at that word, compulsory. From where the citizens and the non-citizens earning income, as long as you earn income in that country, you are expected to pay tax to that government. And someone said another definition of tax is it is the amount of money that must be paid by all the citizens and non-citizens of a particular country to the government based on their income, properties, goods, etc., which will be used to provide social services to the entire citizens of the country. It's money that you or other citizens is expected to pay to the country. Number 1, based on the income. 2, based on properties, because we have a profit tax, and goods, like what we have in VAT and so forth. So that is the definitions of tax. Let's look at number 2, the characteristics or attributes of tax. What are the major features of tax? Number 1, tax is a compulsory levy. It is a must, mandatory for those earning income. 2, It is collected by the government or its agents. Collected by governments or its agents. That sometimes government will appoint some agents or contractors or consultants that collected tax on their behalf. Number three, characteristics or attributes. Tax is not imposed as a penalty for any legal offense. It's not imposed because of penalty. Number four, it is imposed on the citizens, both individuals or companies. We have personal income tax, we have company income tax, we have a petroleum profit tax, and so forth. So as long as this makes profit, or the government will charge tax, so it is imposed on the citizens, both individuals and companies. Number five, it must be backed up by the law. There must be a law in the country that back up the payments and who is qualified and at what rate that tax ought to be paid. Number seven, tax is charged irrespective of the exact amount or service rendered to the taxpayer in return by the government. That is, government does not owe the taxpayer any explanations on how the tax received was spent. Whether government explained, whether they give accounts, and that is not a reason why individuals should not pay their tax. But let's look at the principles of a good tax system, because tax must have a structure. For tax to be considered as good or not, it has to be able to satisfy the basic principles of taxations as propounded by Adam Smith. That you can in Adam Smith in 1979 in his famous book, The Wealth of Nations, referred to as Smith as canon of taxation. By principle, we mean the rules, the reasons, the quality, and the condition that lies behind a particular tax or tax systems. What are these kind of taxations or the principle? Number one, equity. Number two, certainty. Number three, convenience. Number four, economy. And number five, impartiality. Let's look at them just briefly and take them one by one. Number one, equity. For tax to be equitable, tax should be based on a person's ability to pay, and there should be equality of sacrifice. That is, the burdens of tax should be according to one's ability. You heard this word, pay as you earned. It should be subjected to what the person earned and not above what he earns. Number two, certainty. By this, taxpayers should know the exact amount they are expected to pay, when and how to pay it. These are the information that taxpayers need. You don't impose unnecessary money or levy or tax on individuals at any point in time. There should be expected time to be paid and how much is expected to pay. That's certain. Number three, convenience. It shouldn't be a burden to the taxpayers. So the method and time of tax collection should be convenience to the taxpayers. Convenience. Pay as you earn. PAYE is considered the most convenient method of tax system. Here we base our taxations. So it shouldn't be a burden. The person should pay according to his earnings. Number four, principles. Economy. The amount spent in the course of collecting tax should be smaller than the amount collected. That is, the cost of collection should not be more than or outweigh the benefits. Costs and benefit analysis of tax must be put in place so that we don't overspend while we are just chasing a little money. So look at the pros and cons of that tax. Look at what you are expected to get and what the persons or taxpayer is expected to pay. And finally, the another principle of good taxation is impartiality. There should be no discrimination in the collection of taxes. Note, people of equal financial capability should pay the same amount as tax. You should not just moved or imposed on smaller payer of a big amount and then respect the people that are supposed to be paid much more. So there should be no discriminations when we are collecting tax. Let's look at another aspect, reasons why governments impose or levy taxes. What are the reasons why government is charging or collecting tax? The reason why government impose tax include the following. Number one, to generate revenue. I said earlier that tax is a major source of revenue for the government. So the tax levied is to generate revenue. Tax forms an important source of income for governments of a country, which is generated from individuals, partnerships, trustees, companies, and so forth, in order to meet the needs of the entire populace, social services, and other infrastructures is being embarked on from the tax money generated from tax. Number two reasons, general administrative purposes. You see, the administrative machinery of a country may collapse if there is no money to maintain it. Tax, therefore, forms one of the sources to cover such administrative uh, money. So it is necessary. Number two reasons, or number three reason, is redistributions of income in the society. In a society where there's great disparities in income distributions, aggregate demand will fall. So government can pursue a tax system imposing on the people within the high income bracket and use the tax revenue to provide subsidy for goods usually consumed by the low income earners. So because of this aspect of the distribution of the income, the governments impose taxes. Number four, provisions of social amenities. Another reason why governments impose tax is to collect money and used for the provisions of social amenities to the public. This does not mean that the such will come from heaven, but of it comes from the taxations. Number four, to control inflation through fiscal measures. This is done by reducing the purchasing power of money in the country and direct the economy by shaping the economic growth and development of the country. And apart from that, number six is to promote the exportations of locally made goods. Now, a reduction in tax of exported goods would be additional incentives to exporters and will create room for more export business. And there are so many of reasons we can do that finding. Now, let's look at the economics effects of taxation. The effects of taxations on the taxpayers. What are the effects of tax levies or imposed on the taxpayers? Number one, tax increases the prices of goods. Now let's consider the producer. The producers will usually try to recover the amount they paid in form of duties by raising the prices of goods on which tax was paid. Because there is no Father Christmas. If the government collects it, then the people, the producers or the seller will find a way to ship them to the final consumers. Number two effect, it reduces production. If duties are high, taxes are high, production will be adversely affected. Number three, it reduces the income of workers. No matter how small or big an income tax is, it reduces the total income of a worker. A worker cannot collect all that is expected to earn apart from the balance after deductions of tax. Number four, taxing discourages services or savings. The amount one pays as tax may have been what would have constitute the payer's savings. People are complaining they are not saving. Now consider that let's ask for at the end of the month my tax this amount that I would have used that. So it discourages savings. Number five, it causes scarcity of goods in the country. Taxation reduces the quantity of goods produced locally and imported, thereby causing scarcity of goods within the country. Apart from that, number seven, it discourages hard work. When greater portions of one's income is taken away as tax, although in Nigeria we are still the lowest tax paying, if you go to some other country they pay much more. So sometimes a worker will feel that when greater portion of his earning or income is taken away as tax, then the person will not have the zeal to work hard again. Number eight, taxation discourages investors. Both locally and foreign investors will be scared of investing in the tax rate if the tax rate is high, especially companies' income tax and excise duties. Although it is depends, and that's why they say that some countries have more investments than others. If you trace it, maybe because of their tax of that particular country is low, and they want to move their investment to where they have the lower tax. So the taxation discourages investments. Now, let's look at this because problem that is associated with tax collection in Nigeria. There are major problems that is affected the collection of taxes in Nigeria. So let's consider that problems associated with tax collection in Nigeria. This include number one, false declaration of income by taxpayers. False declarations, and because the taxpayers do not want to the government to charge him so much, he would declare smaller income. Many workers, especially those in the private sector, do not reveal their real income. So that's a problem. Number two, improper books of accounts, because majority of the traders keeps improper records and no books of accounts at all. If the book is not there, the book account is not there, there's no way you can track what amount such individual or the company can pay. Number three, it is ignorance of the importance of taxation. You can consider that many people, as a result of ignorance, think that the money collected belongs to the tax collectors and therefore refuse to pay tax. And this is as a result of lack of an overall understanding of the role of taxations in national development. Number four is because of high costs of collections of taxes. The costs of tax collections may at time outweigh its benefits within the country. I will say this when we talk about the canon of taxations, that the costs should not outweigh the benefits. Number five, insincerity of the collectors, the consultants or the agents. Majority of tax collectors are after their personal pursuits and are ready to receive bribe, no matter how small, from the taxpayers in place of the actual amounts they are supposed to pay for a particular period. Excuse me. So because of that, that's not problem, major problem. But we have a major and big problem, and that's mismanagement of government funds. You see that embezzlements and misappropriations of government funds by those at the corridors of power may kill people's enthusiasms, interests to fulfill their civic responsibilities and obligations for paying their tax, because they wouldn't want to see the government squandered and then mismanaged their fund, and then they still have the interest to pay more tax. Number seven is tax evasion. This obviously arises when a taxpayer wistfully fails to report certain sources of taxable income or seek to reduce his tax liability by understating a source of income to the tax authority. And many people do not fulfill their civic responsibilities by paying tax as at when due. And that's a major problem, and there are so many problems associated with tax collection in Nigeria. You can read more about that. Now we want to look at the factors that may enhance efficiency of tax administration in Nigeria. That I will just give you a bullet point. We don't have enough time to go into deep explanation. Let's look at the following are the factors that can enhance the effectiveness and efficiency of tax administration in Nigeria. Number one, voluntary compliance. Two, adequate accounting records. Three, the taxpayer should be educated on the effects of tax payments. Four, competence and honest staff. Five, restructuring of the tax system for simplifications. And then number six, reinstate tax reform mechanisms to build confidence in the tax system. And in fact, if you look at this, just the adverse of the problem associated. So look at them, and then we move on. But let's look at classifications. Classification of tax. There are various ways that could be classified. You can classify it based on incidence of tax. You can classify it based on the tax rate. You can classify it based on the okay, let's just on tax rate. But we are going to look at classification based on the incidence incidence of tax. Incidence of tax. Classification of tax on classification of tax based on incidence of tax. Now, what does it mean? Tax incidence. This is an approach You adopted when we are considering who bears the final burdens of tax. That is where the effective incidence falls. Let's look at two major types of the tax classification under this. Number one is direct tax. Number two is indirect tax. One direct and two indirect. Now, what is direct tax? Direct taxes are those taxes that are based on income of individuals or group of individuals, corporate bodies, or and institutes. In Nigeria, for example, direct tax is progressive. It is graduated accordingly to the level of income. As the name implies or indicates, it is collected directly from individuals and companies. It is imposed on the income of individuals and companies. And that means that the burdens of these types of tax cannot be shifted to another person. It is directly on the person paying, the taxpayers. So this means that the burdens is borne directly by the taxpayers. That's what we call it tax. Direct tax. Now, what are the types of direct tax? Example of direct tax. One, personal income tax. This is a tax on the income of employees, sole traders, partnerships, or pensioners. Number two, companies income tax. This kind of tax is charged on the profits and income of companies that operate within the country, except those in the petroleum operations. Now, we have what we call petroleum profit tax. All these are direct tax. This is a tax levied on companies or entities that engaged in prospecting for or extractions or transportations of petroleum, oil, and natural gas. Then the other one is the capital gain tax. We talk about properties. So this tax on gains arising from the disposal of items of capital in natures of companies and individuals and non-corporate bodies. So these are the sample or types of direct tax. Then the other one is indirect tax. Now, since direct tax is directly on the taxpayers, then indirect tax, these are taxes that can be shifted either partially or entirely to someone other than the individuals or firms. Originally, indirect taxes are levied on consumptions of goods or services, and each person pays according to the level or the rate of consumptions. Very often people that are payers of such tax does not know how much tax he or she paid, because the tax is transferred to the consumers in the forms of high prices. For example, the payers of these tax do not bear their final brunt because the burdens has been transferred to the final consumers. So it means that the final consumers suffer the consequences and not the producers, not the sellers. It's shifted, moved. So indirectly, the final consumer pays such tax. So types of indirect tax. That's a types of example of indirect tax. Number one, excise duties. This we have heard of this. That these are the taxes levied on locally produced goods. Number two is import and custom duties. This is also known as tariffs, and they are taxes imposed on foreign made goods coming into a country, like rice or some other things that are being imported. Then those things are there's amount that the importers have to pay, and when importer pays us the amount, is shifted to the final consumer by increasing the price of that goods. Number three is export duties. These are taxes levied on locally made goods taken to other countries. And then number four is what we call value added tax. That's what we call VAT. These are the taxes levied on sales of goods, consumption goods. Value added tax is a consumption tax payable on the goods and services consumed by any person, whether governments, business, organization, or individuals. Once you consume that goods, you will participate in paying such taxes. So, well, that's the only classification we will consider today. Now, what then are the disadvantages? Let's Okay, because of limited times, let's move to the concept of tax. Concept of tax. What do we look at then? We're looking at effective and efficient imposition of tax. There are some unique concepts in a tax that must be appreciated, and these are several. Number one, tax base. Number one concept is tax base. This is the objects on which tax is imposed or charged. It can be the income of the taxpayer, or it can be gain from certain activities they engaged in. It could equally be on property or asset owned or some services that such payers rendered. Number two concept is tax rates. This is the proportion of the tax base that is payable as tax to the government. It is expressed as a percentage of tax based and fixed by the law imposing such tax law. For example, in Nigeria of recent, the new VAT rate, the rate of value added tax, that is VAT rate is 7.5%. Before that, it was 5%. And companies' income tax, CIT, is now 30%, while the petroleum profit tax, PPT, is 85%, and so forth. Another concept is tax yields or revenue. This is a total amount of revenue generated from tax imposed. It is a product of tax based and tax rate. That is a tax yield. There's a calculation. Tax yield will be equal to tax based times tax rate. The first two concepts, the tax based and then the tax rate. Then for you to know the yield, you multiply the tax base by the tax rate. And number four concept is tax incidence. It is an economic term for the divisions of a tax burdens between buyers and sellers. It does not reveal, or it does reveal the person that will pay the tax liability. For instance, now, if the government decided to impose on increased tax rates, or for example, cigarettes, the producers may increase the sales price by the full amount of the tax. If the consumer still purchased cigarettes on the same amount after the price increase, it will be said that the tax incidence fell entirely on who? On the buyers, that is the final consumers. Another concept of tax is tax burdens. This is the amount of income, property, or consumption tax levied on an individuals or business. The tax varies depending on the number of factors, including income level, also jurisdictions, and current tax rate. You look at that income level of individuals, or maybe the particular sections or jurisdictions where the taxpayers live, and then the current tax rate. So they will see here that the tax burdens, that is the amount of incomes on that property is fully shifted to the final consumers. Then another one is tax impacts. These effects of a tax on the production or consumptions of the product being taxed. For example, now you see the tax impacts of raising the levy on tobacco might be a reduction in tobacco sales, because if this is detrimental product or destructive and is unhealthy products, then the government want to eradicate it. Then increase they will levy, they will put a high rate of tax, and that may actually ground such a product. And then the next one is the tax effects. This is general terms that describes the consequences of a specific tax scenarios with respect of a particular tax paying entity, that is whether individuals or so on. So please, let's look at it is important that we look into this and then and get well equipped. Now we are going to look at tax avoidance, evasions, and maybe we'll look at concessions. Those are very critical in taxations, and we must know it. We'll look at what is tax avoidance, what is tax evasions, and then what is tax concessions. Number one, we consider tax avoidance, a method by which a taxpayer legally reduce his or her tax liability. That is, it occurs when the taxpayer finds a means and loopholes of reducing his tax liability by taking advantages or loopholes of the specific provisions of the tax law. That is a tax avoidance. It is legal, because the taxpayers need to study the financial acts and then look at the provision made and then follow them through, so that it can avoid some of the fines, some of the taxes, either paying late or being fined or paying penalty. So those are the things that the tax avoidance help. It's illegal, and there's nothing wrong with that, but the taxpayer needs to study. So what are we saying now? That tax avoidance is that method by which a taxpayer legally, if you don't remember any other thing, remember that tax avoidance is legal. Now, the tax evasions, this occurs when the taxpayer willfully fails to report a source of taxable income or seek to reduce his tax liability by understating a source of income to the tax authority. This is a criminal offense and it is illegal. When a taxpayer seeks a legal means of reducing his tax liability, and most of Nigeria and those people in the private sector, when they are filling forms, you see them trying to cut corners, and companies also try to cut corners in order to reduce their tax, the tax level they are paying. But then it is illegal. So one thing you must understand about tax evasion: it is illegal. It is illegal, and it is a criminal offense to be involved in this. Then the last one is the tax concession. Tax concession, this is the rights granted to a company by federal government to exploit and extract or mine mineral within an area. This, however, involves applications and granting of mining licenses and explorations licenses, and concessions because of the explorations and minings, and then the payer or the company or individual just get a grant from the government and get license to do that. Now, What then are the example of taxpayers? There are some examples by which taxpayers can evade taxes. There are areas. That mean by what I mean is that the areas taxpayers evade tax. Number one, avoidance of registration under relevant tax authority. You can't trace him. Number two is overstating of expenses to reduce taxable profits. Number three is by making false statements. Number four is understating of income and revenue generated. We have so many of them. Number five is entering into artificial transactions. And then next one is to hiding totally without making any tax returns. They run away when the tax agents or governments comes around. So we look at that. So the next we'll look at the personal income tax. We'll look at personal income tax. Let me put this now before we before we close for today. We'll look at distinction between tax avoidance and tax evasion. Distinctions between tax avoidance and tax evasion. Now we'll have this in a tabular form. In a tabular form, we have three columns. The first column should be serial number, and then the second column should be for tax avoidance, and then the last column should be for tax evasion. Now, under serial number one, under tax avoidance, legal. Under tax evasion is illegal. Number two, under tax avoidance, it is achievable through the exploitations of loopholes in the tax laws or provisions. Under tax evasion, achievable through deliberate actions of fraud and deceit or rendering incorrect returns. Number three, under tax avoidance, results in the taxpayers paying minimum tax possible without breaking the provisions of existing tax laws. While under tax evasion, results in taxpayers paying incorrect tax or paying tax through illegal means. Number four, under tax avoidance, supported by the law courts in decided cases, while under tax evasions, not supported by the law courts. Number five, under tax avoidance, no criminal liability. But under tax evasion, tax evaders is criminally liable and could be charged to court with consequence fines, penalties, and sometimes imprisonments. Number six, under tax avoidance, if stretched to the extreme, the scheme could be disregarded by the tax authorities. But while under tax evasion, At any level, revenues service will frown at tax evasion. Then number 7, under tax avoidance, no revenue service investigation or prior years assessment will be reopened. But under tax evasions, the revenue service investigations will be instituted and has the power to reopen prior years assessments beyond the statutory 6-year limits. So you can see now the difference between the tax avoidance and tax evasion. But before we make progress, something I forget to let us know that there's something that we or individuals or governments will have to do in order to get their tax clearance. There's what we call TCC, tax clearance certificate. Tax clearance certificate. It is very, very key to taxpayers. There are so many things that you can not do without having tax clearance certificate. So let's look at tax clearance certificates. A tax clearance certificate is to be submitted to any ministry, department, commercial bank, or any agency of government with whom a taxpayer has any dealings. Even sometimes to buy vehicles, sometimes to run some political appointments. The certificate must be produced for key issues like appointment by governments, a chairman of membership by the public boards, institutions, or commission, or to any other similar positions created by the governments. So tax clearance certificate are also required to be tendered by an applicant to the Department of Foreign Exchange Control for permissions to remove funds to non-resident recipients in respect of income accruing from rents, dividends, interests on which tax has been paid and in respect of which the application is sought, or that no tax is payable, whichever is the case. So it is necessary that you can't get tax clearance certificate if you have not paid your tax. And it is a must also for a government or tax agent to release the tax clearance to whoever that paid his tax updates. So we must have to get along with this. Another aspect of taxation we need to consider is the what we call TIN. TIN, very, very important. So let's look at the introduction of TIN. The full meaning of TIN is T stand for tax, and I stand for identification, and N stand for number. So we're looking at that because it's also, yeah, that's why that once you register a company, in fact, this is one thing that the government, the tax authority is using to track and bring everyone into tax net. So if you don't have TIN, you cannot, in fact, you can't even open accounts. Your TIN is attached to your account. So the TIN means tax identification number. It's a unique subsequential 14-digit number generated electronically as part of the registration process and assigned to a taxpayer. That taxpayer may be company, enterprise, or individuals. For identification, this number eases tracking or helps in tracking the taxpayers and access to their tax history and records. It means that there's no business that you do as long as you open an account that you register that business, that the tax agent or tax authority will not be able to track you. So this is done in collaboration with the State Board of Internal Revenue to enhance exchange of information. This has to lead to the discovery of fake clearance certificates and others ploys to evade tax by taxpayers. So of course, you heard about this thing is very, very key in Nigerian economy today, because this is the only thing that the tax authorities can really track and get the real truth about taxpayers. So once you open accounts or you register a company, already this is electronically generated. So sometimes you want to go and open an account, they will ask you for your TIN, and then the bank will help you to do the search, and then either they bring it out, you pay some money, and as long as this search, TIN is there, you cannot fake your tax to tax authority. So it is important that we know this also. Let's look at tax laws. Tax laws in Nigeria, there are various laws governs our tax. These are the various legal instruments put in place to ensure the realizations of tax policy and objectives of the government. Now, the various legislations imposing taxes on individuals and corporate bodies in Nigeria. In Nigeria, there are several statutes or laws which regulate taxes of individuals and corporate bodies. And these laws or statutes has been subsequently reviewed and amended from time to time. These include the following: what we call Personal Income Tax Act, capped P8, LFN. L is in capital, F in capital, N is capital. So capped P8 LFN, Law of Federal Republic of Nigeria, 2004, as amended. The Personal Income Tax Act regulates the assessments and the collections procedures for the individuals or the body of individuals, including family, corporate body, sole traders, trustees, or executor, having any income which is chargeable to tax under the provisions of the Act. Essentially, the Personal Income Act covers the liability of tax of the following. Number one is the taxation of employees. Number two is the taxation of sole traders. Number three is the partnership assessment. And number four is the taxation of estate, trust, or settlements. So these are the types of taxation that are classified and treated under this law or personal income tax. Number two act is the company's income tax. That is in company income tax capped C21 LFN of 2004. This regulates the assessments and the collection procedures for the taxation of all corporate bodies other than those in the production of crude oil or gas. In fact, the Companies Income Tax Act, CITA, CITL, Company Income Tax Act 1961, applies in relation to companies throughout the federations as from 1st April 1961, was repealed and replaced by the Companies Income Tax Act of 1979, and subsequently repealed and replaced by the Companies Income Tax Act 1990. The rate of companies income tax is currently 30%. So currently, the company's income tax is governed by CAPS C21 LFN 2004. It should be noted that recently the federal government passed into law 2019 Finance Act in January 2020, and for the purpose of the Finance Act, companies are divided into three parts: the small, mediums, and large size companies. Nice. Another tax law is Petroleum Profit Tax Act, CAPS P13 LFN 2004. Now, this act covered the Petroleum Profit Tax Act of 1959, as amended, regulates the taxations of companies engaged in petroleum operations. That is, companies engaged in various engaged in producing of oil. The petroleum marketing companies are actually charged to tax under CITA, that is Company Income Tax Act of 1979, as amended. The Petroleum Profit Tax Act was also amended in 1990 and amended 2004. The next one is the value added tax decree number 102 of 1993, as amended CAPS V5 LFN 2004. This is a tax consumption which became effective in 1994. It can also be regarded as tax charged on value added during the course of productions of goods or services. We have another one we call capital gains tax 1967, as amended CAPS C1 LFN 2004. This is a tax imposed on profit derived from sales or disposal of a chargeable asset. Example, options, debts, incorporeal properties, currencies other than Nigerian currency, and all capital expenditures. The rate currently is 20% up to the rate is 20% up to 1995 tax year, but with effect from 1996 tax year up to date, the rate was reduced to 10%. The whole ideas of amendment is to boost capital market activities and then encourage investment. You can see that in 1998, the additional incentives to investment is the fact that the chargeable gains on the disposals of stocks and shares of all kinds are now to be exempted from capital gains tax. The other one I'm not going to is the what we call a educational tax degree 7 1993, as amended in 2004. So we will end our class today here. Next we deal with personal income tax computations so that we know how to calculate and then compute personal income tax. Thank you for listening.